Good morning, good afternoon, good evening. My name is Market Maker 69420, and in this episode, we're going to talk about the market close and how it affects the economy. As the trading week wrapped up on Friday, March 6, 2026, markets grappled with potent mix of disappointing U.S. economic data and surging energy prices amid escalating Middle East tensions. A shocking jobs report revealed a loss of 92,000 non-farm payrolls in February, pushing unemployment to 4.4% and fueling fears of economic slowdown, while oil prices spiked over $90 per barrel due to ongoing U.S.-Israel-Iran conflict. This dynamic rippled across asset classes, boosting commodities, but pressuring risk assets like stocks and cryptocurrencies, setting a cautious tone heading into the weekend. All right, let's analyze the stock market. The U.S. stock market closed sharply lower on Friday, March 6, 2026, extending weekly losses amid weak labor data and rising energy costs that heightened inflation concern. Major indices resumed their slide, with the Dow suffering its worst week since April, reflecting broader risk-off sentiment. When looking at closing price action and direction, the S&P 500 dropped 1.36%, the Nasdaq fell 1.59%, the Russell 2000 declined 2.32%, and the Dow Jones slid 0.95%. Intraday trading saw the Dow plunge over 500 points and the S&P 500 dip more than 1%, driven by oil shock and ugly jobs report. This marked a continuation of the volatile week, with the Dow down nearly 700 points overall. Looking at volume and liquidity, trading volumes were elevated in response to jobs data release at 8:30 a.m. ET, contributing to heightened intraday swings. Liquidity appeared strained in smaller caps, as evidenced by the Russell 2000 outsized drop, signaling reduced risk appetite among investors. Looking at options expirations and pinning, with a significant 2.68 billion options expiry looming, including heavy Bitcoin contract, markets exhibited pinning behavior around key levels, exacerbating volatility. No specific pinning effect were noted for equities, but the broader expiry event likely amplified late season move. Looking at sector rotation and breadth, energy stocks were mixed but leaned positive amid oil rallies, while financials and tech sector dragged the indices lower. Market breadth was poor, with decliners outpacing advancers significantly, reflecting rotation towards defensive plays like utilities amid economic uncertainties. When looking at the VIX behavior, the VIX, often called the fear gauge, spiked in response to jobs myths and geopolitical risk, indicating elevated investor anxiety. While exact closing levels weren't detailed, the context of oil surging and stocks sliding suggests a notable uptick in implied volatility. When looking at after-hours futures and pre-market indicators, S&P 500 futures pointed lower in after-hours trading, influenced by ongoing Middle East development. Pre-market indicators for Mondays suggest continued caution with potential for further downside if weekend news on the Iran conflict escalate. When looking at news flow and event, the headline event was the February jobs report, showing a minus 29,000 non-farm payroll print versus expectation of 59,000. Unemployment rising to 4.4% and retail sales dipping down 0.2% MOM. Geopolitical tensions, including the U.S.-Iran war entering its sixth day and the closure of the Hormuz Strait, drove energy price shock. Other news included stalled progress on crypto regulation and Fed speakers hinting at paused rate cut. Looking at economic and technical context, economically, the data underscores a vulnerable labor market, potentially delaying Fed rate cuts at the March 18th FOMC meeting. Technically, indices breached key support levels, with S&P 500 testing its 50-day moving average amid overbought conditions from prior rallies. Broader sentiment remains bearish, with tariff and geopolitical risks adding to downside pressure. This close impacts the stock market by amplifying recession fears, likely leading to reduced corporate earnings outlook and tightened financial conditions, though energy sector gains provide some offset. Now, diving into the commodities analysis, commodities settled higher on Friday, March 6, 2026, led by a dramatic surge in energy prices as Middle East conflicts disrupt supply chain. The sector's strength contrasted with equities' weakness highlighted its role as an inflationary hedge. When looking at settlement prices and daily close, crude oil settled at $90.85, up 12.13%. Brent crude at $92.76, up 8.44%. Natural gas at $3.16, up 5.26%. Gold at $5,179.20, up 1.98%. Silver at $84.70, up 3.05%. And copper at $5.84, up 0.61%. When looking at position management and weekend risk, traders manage positions cautiously ahead of the weekend, unwinding shorts in energy amid high geopolitical risk. Weekend risk premiums were evident in oil surge, with potential for gaps on Monday if Iran tensions worsen. When looking at liquidity and volatility patterns, liquidity was strong in energy contract, with crude oil volume at 949,443 and natural gas at 184,192, reflecting aggressive trading. Volatility spiked, with oil's double-digit gain underscoring supply shock sensitivity. When looking at open interest and rollover, open interest rose in key contracts such as gold 262,874 and crude oil 255,814, indicating sustained interest. Rollover activity was routine but elevated due to front-month expectations amid price swing. When looking at macro and fundamental news flow, the weak U.S. jobs report, minus 92K, and the Middle East war, including U.S. strikes on Iran, and the Strait of Hormuz closure fueled the oil rally. Fundamentals pointed to tighter supply, with Qatar halting natural gas production and U.S. airlines rising on higher fuel costs. Looking at technical levels and order book, oil breached $90 resistance, with next targets at 120 if tensions persist. Order books showed heavy buying in energy, while metals like gold tested all-time highs on safe haven flows. Looking at broader market sentiment was bullish for energy but cautious overall, with oil surge reflecting crisis crisis escalation, while metals gained on Fed rate cut bets post-jobs data. The Friday close bolstered commodities as a hedge against inflation and geopolitics, potentially supporting producer margins but raising input costs for other sectors. Now let's head into the cryptocurrency analysis. The cryptocurrency market extended losses on Friday, March 6, 2026, with major assets declining amid risk-off flows tied to job misses and oil spike. Total market cap dipped down to $2.48 trillion, down 2%. When looking at liquidity levels, Bitcoin's 24-hour volume hit 45.158 billion with market cap of 1.365 trillion. Ethereum's volume was 20.694 billion with market cap of 238.486 billion. Stablecoins like Tether showed high liquidity at 84.119 billion volume, providing a safe haven. When looking at volatility and price swings, Bitcoin fell 3.8% to 68,231 and 69 cents, dipping below 69K. Ethereum dropped 4.72% to 1,975 and 62 cents. Altcoins like XRP down 3.37% and Solana down 3.66%. Saw similar swings, with some like Monero down 6.47%. Looking at trading volume trends, volume remained robust in majors, but trended lower overall, signaling reduced speculative interest amid macro headwinds. When looking at news, rumors, and external events, Bitcoin died post the minus 92,000 jobs report. Other news included Ripple's institutional push, Google's TerraWolf backing, and stalled Clarity Act progress. Rumors of AI predictions favoring XRP and 38% of altcoins below FTX lows added to the ghost town vibe. When looking at correlation with broader market and the macro factors, crypto mirrored equities decline, correlating with jobs data and financial stock drop. Gold's outperformance highlighted a shift to traditional safe haven, breaking Bitcoin's historic dollar ties. Looking at risk management considerations, high volatility necessitates hedging, with options expiries 2.68 billion, adding pressure. Stablecoins offer low risk parking, but altcoin weakness suggests caution on leverage position. This close weighs on cryptocurrencies by reinforcing their risk asset status, potentially delaying adoption amid macro uncertainty, though regulatory process could provide long-term support. In summary, the Friday close on March 6, 2026 underscored a bifurcated market landscape. Commodities thrived on supply shock and safe haven demand, while stocks and cryptocurrencies buckled under economic weakness and inflation fear. The interplay of a dismal jobs report and Middle East escalations could prolong volatility, pressuring risk assets in near term but bolstering energy plays. And investors should monitor weekend geopolitical developments and upcoming FOMC for cues, as these factors may dictate whether the current downturn deepens or stabilizes into next week. That's all I got for you today. Thank you for listening. If you enjoyed the content, don't forget to like, comment, and subscribe. And if you'd like to support the channel, feel free to buy me a coffee on my Patreon. Thank you. Bye-bye.